Hello and welcome to episode 10 of the Irish Home Show. I'm your host, Ben Thompson, the friendly estate agent, and each week I'm taking you through each of the stages in the house buying process in Ireland. So far we've taken you from savings to mortgage approval, through house hunting, and finally going sale agreed. In the last 2 weeks we talked to Suzanne Parker of Parker Law about the steps of picking a solicitor and what they do for you when you're buying a home. And last week I spoke to Niall Tate of Get House Survey about getting your survey done on a property. This week we're going to talk through the last few steps on the financial side of buying a home and finally getting the keys to your new house. First, in my explainer section, I'm going to quickly run through all the steps you're going to be taking with finally agreeing your mortgage, getting the valuation, and also talking about home insurance. Then I have a great interview with Niall O'Connor from beatthebank.ie. They are a fantastic new mortgage protection service, and he is going to talk you through everything you need to know about mortgage protection, why you need it, what it's there for, and how to make sure you are set up so you have it ready when you need it, when you're coming to draw down for your mortgage. Finally, at the end of the episode, we'll be going through our usual features of in, out, and away, looking at properties around the country to see what you can afford where. And then new home versus old home. I'm going to be picking a new home in an area and then a similarly priced old home and see what you can get for the value for money. And finally, at the end of the show, I'll be wrapping up with the latest property and housing news for the last couple of weeks. So stay tuned. Thanks for coming back. Please subscribe and follow us on all our social media at Irish Home Magazine to see a lot of the visuals from this podcast. Welcome to the Sale Agreed Explainer section, part 2. Now in episode 8, we covered the first 3 steps you're going to take when you go sale agreed on a property. First, paying a booking deposit to the sales agent to secure the property. Second, to appoint a conveyancing solicitor who's going to handle your side of the sale. And 3 is booking a surveyor. We talked last week to Niall Tate of Get House Survey about what surveyors do and how to book one. Now this week we're going to cover the next few steps that are really important in going from sale agreed to getting your keys. That is going to be around the financial matters around the property. First of all, and most importantly, starting with your mortgage. Now, you would have already had mortgage approval with your bank before you even started bidding on properties. This is your approval in principle, AIP. This is just a term, a figure that they will allow you to borrow on a property. It's hypothetical at that stage until you actually find a property and go sale agreed with the owners and the agent. Now that you've done that and secured the property and know the figure you'll agree to pay on it, they can kick into gear and start all the paperwork off around that property. So first of all, you're going to need to provide them with the name of the property, probably the agent's name and details so they can contact them as well, and the price that you have agreed to pay. Now this will get sent to your solicitors on both sides by the agent as well when they write to them, but you can pass this on straight to your mortgage broker and bank and they can get the ball rolling on all the financial details. Your bank is going to go through a process of turning that approval in principle, that hypothetical loan, into the real piece of paper that is going to be your loan on the properties, your full approval. That is going to be specific for the name of the property and the price that you are paying. Now they go through their own steps of due diligence with support from your solicitors, including getting a valuation on the property. Now they might instruct someone to go out and you may be hands-free. Sometimes they will give you a list of valuers that you can use and you can go and pick one yourself. The valuation is usually pretty straightforward in any normal market. The valuer will go out and see that you are paying a fair price for the property. If it's been properly marketed and perhaps you're bidding with other people, that shows that you are buying the property at around the right market level. It's very rarely do they reject a property. And at the end of the day, they are also just going to see that the property exists and it is the right number of bedrooms that are on paper, and just to protect the bank to make sure that you are buying what you say you are buying. Now, you will have to pay for the valuer. It's usually around 150 euros. It can be slightly more perhaps, but you have to pay that out of pocket yourself. Now, this valuation usually has a finite period. It may be 4 months or 6 months. So it's sometimes best. You would normally be encouraged to do it straight away once you go sale agreed. Perhaps if you are expecting a longer term, maybe there is a property still in probate and you're thinking it might take longer, it may be cautious to delay it a little bit. Otherwise, if that 4 month clock expires, you may have to go back and pay another 150 euro for another valuation, which we don't want to do. So just hold back on that if you think it might take a while, but otherwise, best to get on with it. Now, the final thing as well is, now that you have agreed the price you're going to pay, you can start locking in or agreeing to the terms of the mortgage you were taking out. Again, before you found a property and when you were applying for it, it was all kind of hypothetical. The bank would be quoting you the rates that they're offering, whether for a variable term, which goes up and down with central bank interest rates, or a fixed term that may be a single figure or a payment that will be for the next 5, 10 years or whatever fixed term you take. Now it's time to come and fix the agreed rate that you are going to take from them. Well, it may have changed since you first got approval, especially in the last few months when interest rates have gone up. So now is the time to have a look again and reassess, and maybe take advice. If you're using a mortgage broker, it's worth talking to them, but it is a very personal thing. You can go with a variable rate, which will usually be lower at the moment, but it could go up and down as interest rates go up and down in the next few months. Or you can go with a fixed rate, which will lock you in for a fixed period of time, so you know exactly what you're going to be paying. They can typically be 2 or 3 or 5 years, some longer ones like 10 years, which gives you great peace of mind that you're going to have the same rate for the next 10 years and you don't worry about it. Now, after that, you may have to reapply and it may go up. That's a risk you're sort of willing to take. You're having to make a decision now. Do you think, look, would I rather have the certainty in the short term, and I'll worry about that in the longer term? So you're going to have to think about agreeing that now. The final rate is only agreed almost at the last minute before closing, but just start going through the process now of looking at those figures and what it means for you. Also, in terms of agreeing what price you're going to pay, you now know exactly what you're going to have to pay in terms of a deposit. If you're a first-time buyer, you are paying 10%. If you maybe got the house a little bit cheaper than your approval in principle, then you just have to recalculate what money you're spending on the property and what is coming from mortgage and what is coming from your savings as a deposit. We have a great final budget check page in the Irish Home Buyers Journal, and that allows you to finally put on paper what you've agreed to buy the property for, what your loan would be, and what your deposit needs to be. And then calculate what you have left over. You know by now what your legal fees are going to be. You've probably paid the survey, you've paid the €150 valuation fee. It's a good time in your process to work out exactly your costs, what you have saved, what you have for a mortgage, and work out what you have left over for furnishings or refurbishments or moving costs, etc. So sit down now that you know what you're buying, the big uncertainty is gone, the figure you're going to buy the house for, you can work out all the details and see what money you have left on the table. Now, in addition to agreeing the loan that you're going to get, you're also going to be deciding at this point about home insurance, mortgage protection, and perhaps some other insurance or financial products. These are things that you probably don't think about too much in advance when you're house hunting or trying to get the mortgage approval. That's all you can really think of. But these are very important actual essentials that you need to have in place before you can draw down your mortgage and buy the house. So first of all, home insurance. In a snapshot, home insurance covers the risk of your house having a severe issue, a leak or something falling down or burning down in a fire. Home insurance is to cover the value of rebuilding the house. For typical houses, it may be 50 to €100 per month. It's not a huge amount, but you are going to be paying it over the lifetime of the time you own the home. It is a requirement to get a mortgage on a house to have home insurance. Now, just a quick thing on the value of the property. You may be going out and buying a house for €500,000. That's the market price of the property that you are willing to pay. But for home insurance purposes, they take what is called the rebuilding rate. So that is the cost of rebuilding that house exactly the same as it is now. So in case it did fall down or burn down, there would be an insurance policy in place to pay you the total sum you would require to rebuild it. Now, that figure can be different from the market price you're paying, depending on where you're buying. If you're buying a house in an expensive suburb in Dublin, the market price is probably going to be a lot more than the cost of rebuild. And then again, if you're buying something down the country, the price of buying it is probably cheaper than the cost of rebuilding it. Now, there are some differences if trying to rebuild a 4-bed house in Dublin and building a 4-bed house in Westmeath or something like that. You know, it would be slightly cheaper in certain areas depending on the location and restrictions and materials. But in general, the cost of building a 4-bed house is mostly quite the same across the country. You can go and find out the average rebuilding cost of your particular property on the SESI website. That's the Society of Chartered Surveyors Ireland website. There you can find their rebuilding cost calculator. So say if you have a 4-bed house, it may be that it would only cost you $450,000 to rebuild. You're insuring the property for that amount, not the price you're willing to pay. So just when you're entering it in, whether you're doing it with your bank or a broker, or you're doing it with another independent insurer, make sure you have the right figure in there. Otherwise, you may be over or underpaying for what you need. Alongside home insurance, there is also contents cover. This is usually included in it. You've done the cost of rebuilding the house, but you're also going to insure the cost of your content in it. At this stage, you need to do a valuation. Now, there are sort of typical averages. Some people will put 30,000, some people put 50,000, some people may be putting more for a bigger house, or if they have a extensive shoe collection or something like that. But it is to cover the cost of everything in your house, and it can be quite considerable when you add it up. If you add up all the plasma TVs, your clothes, it may include appliances, a large fridge or an oven or something like that. If you add it all up, what would it cost you to replace everything in your house, including all the kids' things, including all your valuables and worldly possessions? So it's something worth adding up, and this is going to be in addition to your house. Now, for apartment owners, you are buying an apartment in a block. The block cover will cover the insurance for the building itself and the built landscape around it. So if anything happens with that, that'll be covered by the block insurance. You don't need to worry about that. You're probably paying a portion of that in your service charge. You do need home insurance for the inside of your property. So anything within your four walls in an apartment block is yours to cover. So say if there's a leak in your sink and it damages your wood floors, that is something that you would claim on your own insurance. If it is anything outside of that, if it's a leak from someone upstairs that comes through and ruins your ceiling, that is for the management company to take responsibility for and mediate. So you need to have sufficient insurance to cover the inside of your property, plus your contents as well. That's home insurance. The second thing is mortgage protection. Now, in my interview coming up, I'm talking to Niall O'Connor from Beat the Bank. They are the experts in mortgage protection. He will go into more detail there. But in a brief snapshot here, mortgage protection is an insurance policy you take out in case you, the earner, whether it's yourself or you and your partner, are unable to continue paying the mortgage in the case of perhaps your early death. The bank needs to be guaranteed that they will receive the repayments that you promised to pay for the next 30 years. It's a life insurance policy, but it's not for you, it's for your bank. Now, that might feel a bit strange. It feels like that if, in the unfortunate event of your death early, the bank gets the money and not your family. But it does mean that the mortgage is paid off. So say if I passed away and we still owe $250,000 on our loan, that would be paid off because of our mortgage protection insurance. And it means my wife and kids would keep the house mortgage free and it would be paid off and they wouldn't have to worry about that. It's something that you are legally required to take out when you're getting a mortgage in Ireland, but you may supplement it as well. You may increase it. You may add to it with a life insurance policy. So say if I passed away, unfortunately, it may be that the mortgage get paid off and there'd be another 100 or 200,000 euros there as a pot of money for my wife and family to live off in the absence of my income. So they are essentials. Mortgage protection is a requirement. Life insurance is an optional extra if you can afford it and if you think it's necessary. So that is something to look into. We'll talk about more of that in a minute in our main interview. Finally, with regard to all these insurance policies, a lot of people just go with whoever their bank offers them. So if you're banking with AIB, they have a tied insurer with Irish Life. If with Bank of Ireland, it may be with someone else. They will put a policy in front of you with a few variables, but with only one company that you're being offered a policy from. And you're not tied to it. You don't have to go with them. But at this stage in the buying process, it's very easy just to sign on the dotted line. You want to get on with things. You sign all the papers and you just take whatever rate you're being offered. I'd stop at that point. It's worth shopping around. This is a financial product that it doesn't need to have extra bells and whistles to it. It is a straightforward requirement. You need a certain amount, but it is a numerical figure. There's no sort of nuance to it. If you can find a cheaper rate, but you're not getting a lesser product, you're better off getting out there and finding the best rate you can for what you need. So when we talk to Niall at Beat the Bank, you can hear from them about how they try and give the lowest rates in Ireland, and definitely shop around. Don't just go to your own bank for home insurance and mortgage protection and life cover. Talk to an expert. All right, let's move on and get on with my interview with Niall from beatthebank.ie. So this week on the podcast, I'm delighted to introduce Niall O'Connor from beatthebank.ie. Niall, how are you?
Good, thanks. Thanks for having me on.
Good, it's great to have you. Now, as you know, we've been following through the series of buying a house, from starting with savings, going for mortgage approval, getting sale agreed, And we're at that stage now where people have secured the property they are going to buy, and they're probably rushing around to finalize what interest rate they're going to get and get all their details ready with their solicitor to finally close a sale. This, I think, is a perfect point to talk about mortgage protection. It's something that a lot of people probably don't even think about in advance of this stage. They probably haven't ever even known it existed. But look, tell me, what is mortgage protection and why do buyers need it when they are buying their first house?
Okay, it's a good start, Ben. So essentially mortgage protection is something that the bank needs a plan assigned to the mortgage that you're drawing down with that particular institution. So an example I give you, if someone is applying for a 300,000 mortgage, they have to have a minimum of life cover for that amount plus the term that they're taking out for, which may be 25, 30 years. That plan is essentially assigned to the bank, and as part of your loan offer, you'll have what's called a deed of assignment. And essentially the bank take ownership of that plan. So God forbid something was to happen throughout the term of the repayments of the mortgage, is that the bank have the first say on where that a fund is paid to. So in an example, that with a life company, if someone passes away during the term of the mortgage, the amount will be paid directly to the bank, and any residual amount that's after the balance has been cleared goes to the next of kin or to the estate. So mortgage protection essentially it's a life cover plan assigned to the bank on a decreasing level basis, where in line with the mortgage repayments coming down, to ensure that there's enough cover to protect the bank essentially, should one or both parties in a mortgage unfortunately pass away throughout the term.
Okay. Yeah, okay. So to get this clearer in my head, everyone knows what life insurance is. It's sort of a cover that will pay out if you pass away, if you're the main breadwinner, for example, and that your family will be covered. This is slightly different because it's not your family that's getting the money initially. It's your mortgage bank, essentially. Is that right?
Yes, and so a lot of people confuse what mortgage protection and life assurance is. So life assurance, for example, if someone takes out a life insurance plan, it's not mandatory to take it out, because it's not for a particular event. But the reason why someone would take out life cover is if they have dependents on their income, or if they have young children or a spouse. And the reason for that is it's a tax-free payment that's paid to your spouse in the event of you passing away, to ensure that they're able to sustain the standard of living that they have. So for mortgage protection, you actually lose ownership of the plan. It's assigned to the bank, and the bank are the one who get first sort of divvies on that amount of money, because they want their money back. So essentially why it's a legal requirement is because the last thing they want is one or two of the main providers of the house not having a mortgage protection plan, someone passing away for whatever reason over a 30-year, 25-year period, and essentially, where do they get their money back from? They can't get the money back. They don't want to be seen to obviously having to put their family through financial devastation and a financial, I suppose, situation where they can't afford to pay it back, or essentially that they have to repossess the home. That's not a situation the bank want to be in, or the individuals in that family, because you're going through financial devastation and a family devastation at the same time. I've dealt with claims over the years, and unfortunately, a lot of people say, why do we need to take it out? Why are we being forced to take it out? It's actually to protect your family, essentially, that they don't have a loan hanging over their head should something happen to the two or one main person in the household that's actually secured the mortgage on the property.
Yeah, that sounds like a better way to think about it, that it's not just, this is going to the bank. It's actually that if, say, you were the main breadwinner and you passed away, that your family the mortgage would be paid off at that stage. They would own the house outright. They wouldn't be in an unstable financial or housing situation for the rest of their lives if you have a spouse or kids or whatever. So that I think it makes sense to me there, that it is much more reassuring to have as something that's essential.
And I suppose one question we always get asked is just when the documents come out to somebody is, why are the life insurance company assuming a rate of 6% interest rate on your mortgage protection? And essentially why they do that is there's a buffer there to make sure that the mortgage protection plan will always have a residual of life cover over what the balance is going to be. Now, obviously, hopefully we're not with inflation, we're not going to go to 6% interest rates. Essentially, the life companies may have to reassess that, but it's making sure that the plan will always have an element of life cover that can be paid out to the estate, God forbid something's to happen to someone else. Because the last thing you want is a shortfall in the life cover. For example, back to the 300,000, say someone passes away 15 years in and it's 150,000 left, and the life cover plan only pays out 130. where does that 20,000 difference come from? So that's why they assume a 6% rate. It's nothing to do with the interest rate you're actually paying, you're actually drawing down on. It's just to make sure that there's a buffer.
Okay, yes, you use that 300,000 figure. Yes, so say I've gone and bought a house today for 400,000 euro, and my mortgage is 300,000 euro. The life insurance will cover that amount if I die the next day. But as you said, it decreases over time. So as over a 25 or 30-year term, I am slowly paying off the capital sum of my mortgage, and say in 10 years' time, it's only 200,000 euro. The life insurance policy decreases, so the amount you're paying monthly would naturally decrease. Is that right?
The amount you're paying per month stays the same, but the amount of life cover you're getting is reducing. But there is an opportunity to take out either a decreasing mortgage protection plan, which is, as you said, it's decreasing the amount of your mortgage payments, or there's a level term where the cover back to your 300,000, where it stays 300,000 for the whole term of the plan. So in that scenario is in 29 years' time of 30-year mortgage, the life cover will still be 300,000. But obviously the loan will be close to maybe 10, 15,000 left on it. So some people go with that option because obviously when you take out life insurance in your early 20s or 30s, is that it's going to be a lot cheaper than it is, say, 20, 25 years down the road. So again, it's suppose it's down to the individual, their personal circumstances and what they feel is important to them. But from a point of view from what we do, I would always say to people is give the bank the minimum they require, which is life cover on a decreasing basis, and then look at your overall holistic financial planning, which is you, yourself, your partner, your family, to make sure that you have benefits in place that are going to protect you, not the bank.
Yes, so a lot, and this is what I did when I signed up for my mortgage protection, is that I have a mortgage protection policy and a life cover as well. So the mortgage company gets paid off, and then my family would get another 250,000 or 300,000, whatever it is, which would sustain them for the rest of what would have been my working life if I had passed away.
And also just to say is that there is an opportunity, and this is probably more prevalent when people go in to meet the bank advisor. What they try and do is they try to sort of, the plan that you're proposed to you would be a mixture of a couple of things. It might be a mixture of life cover, it might be a mixture of illness cover, it might be a mixture of bill cover. So people get completely flustered and confused about what actually they're taking out. So what I always say to people is the best thing to do is to go to either an independent person who can advise you on particular products that should be taken out at different stage of life. And obviously when you're taking out a mortgage, it's a massive financial commitment for the longest period of time in your life. So it's really important that it's structured correctly. So give the bank the basics in relation to giving you the mortgage, which is the mortgage protection, and then look at a holistic financial plan for you and your family, and which essentially means looking at, have you income protection work? Have you benefits in work? Have you personal cover you need to consider? And then, I suppose, instead of doing it all at one time, is make sure that you map it out correctly so you understand exactly what you have, exactly what you're paying for, and exactly how it's going to be paid out. And essentially, in an hour sitting in a branch somewhere around Ireland, you're not going to get that level of understanding, education, and you're going to be completely, I suppose, confused about what you've actually taken out. And unfortunately, again, back to the scenario, if someone passes away or someone gets ill and they've illness cover on their mortgage, it gets paid directly to the bank because they own that plan. So why would you not extrapolate life cover out and illness cover separate, where the payment goes to you, so you can decide and your family can decide, depending on the illness, whether you want to pay your mortgage off early or you want to, if you can't work for a year, that you have that buffer of elements of cover in your bank that you can distribute the way you want it versus going directly to the bank. But again, that's more advice-based. I suppose what beatthebank.ie does, it's more getting people cover that essentially ticks the box for them and essentially does it in a much more timely fashion than it would if you go through your institution that you're taking the loan out with.
Yeah, well, I'll tell you exactly what I did, which is probably everything wrong that you're not supposed to do. Given your advices, we were, most people are rushing to get those keys for the house. You've got it said agreed, your mortgage valuations have gone in, the approval's gone through, and you just wanted to get the sale closed and over the line and agreed. And I think for us, it was coming up to Christmas. We had a baby on the way, and we just wanted the keys to the house so we could get in. And we would have signed anything to get those keys at that point. So we didn't even worry about it. It's a long-term issue that you think, I'm not going to pass away, or I'm not worried about if the mortgage gets paid. I just want the house right now. That's all you're focused on after a long buying process. And I probably went in, as you said, we went into the local EBS and they probably put a couple of proposals on the table and we just signed whatever it was. We didn't care at that point. It just said, look, if this gets us the keys quicker, we'll take it. And it's only after we were in the house for maybe a year or two and they look back and take stock and you go, well, actually, that policy completely doesn't work for us. And I think what you say, almost the majority of buyers these days do just go with whatever their bank provides, and whether they're with AIB or EBS or Bank of Ireland, each of them it's not actually provided by them, it's provided by a separate insurer like Irish Life, something like that. I think a lot of people are making that error. What do you guys do, and why have you come to trying to shake up the market and change that?
I suppose, so I'll just start with the second question first. So I suppose the reason why I set up the site is I'd worked for a big life company for about 15 years, got unbelievable training in relation to, customer financial planning, I suppose, and a lot of different skill sets, and worked in a lot of different areas within the company. But essentially I went on secondment to one of the largest banks in Ireland for 4 years. And I suppose financial planning doesn't really fit into a banking model, in my view, because banking model is more transactional. So you want a mortgage, you apply for mortgage. You want a car loan, you apply for car loan. You want PCP through your local dealer, it's done through a bank. So essentially when it comes to life insurance, while it is a transaction for mortgage, you're just one of a massive number of people on a spreadsheet in some branch, and that they have to get you, the cover to give you the mortgage. So I suppose why over the years I'd seen a lot of people, probably pre-COVID and before I left, where you were dragging two people into a branch to sign a form from two parts of Dublin, completely frustrated because they weren't positioned with the life cover or the elements of need early on in the stage. And the traffic in Dublin essentially is, I cover Dublin, so it was trying to bring people in to two different parts of Dublin into one branch to sign a form. Now that's probably not down to the bank, that's probably the life companies, because they were sort of not forward thinking in the sense that you're moving towards a digital environment where you had to physically sign. So essentially what happened in COVID is, I suppose the opportunity, or the last piece of the jigsaw for us, came to the forefront. Life companies were forced to be able to accept electronic signatures. So as a result of that, it was the last piece of jigsaw for us to say, we can now build a digital journey for a client to strip out all the stresses and hassles of having to go off and ring different life companies to get different prices, to compare apples and oranges, because some people call like illness cover, for example, specific illness cover. Some call it critical illness cover. So people don't understand what they're actually comparing. So when we built the site, the main things we wanted was that they get a quote in seconds from all the providers, okay? And then they're able to apply in minutes without someone ringing them up and saying, you should consider this, you should consider that, just to sell add-ons, okay? So essentially giving people the solution they wanted. And again, we're probably more, more open to these sort of digital environments because of companies like Revolut, who are a digital bank. They give you a better service than your local branch, yet they don't even have a license in Ireland. They have a European license to operate here, but they give you an unbelievable suite of products within one app. So I sort of took pieces of the jigsaw from loads of different, companies that we'd read white papers on, that we'd seen startups in different countries, and said, we can do something here that's going to add value to the clients, and more importantly, it's going to give them value. By stripping out interaction with human beings, it means that the costs are cheaper. If the costs are cheaper, you transfer it back to the person who's the end user. So people sometimes say, that's only €20. It's only €30. That's what they say to me, there's a difference of 20 quid a month. That's 20 quid a month every month for 12 months by 35 years. That means, in that scenario I'm going to give you, that's €240, okay, over, say, 30 years, right? So just roughly say it's 7 grand. You have to earn 15,000 more of your income over that period for the exact same plan. It's life cover is life cover. So people say, oh, well, Irish Life are better than Zurich or they're better than Aviva. At the end of the day, life cover pays a benefit out in the event of death. Okay. Once you have filled in the application to the best of your knowledge and the best of your ability, and it's accepted by the life company, they're standing over that risk. So what you're doing is you're paying a premium to transfer the risk off your shoulders to a life company in the event of something happened to you. Protects the bank first, but essentially protects your family to be able to stay in the home. So that's why Beat the Bank was what I suppose was the sort of the brainchild for me, was we have to give people a better experience in the insurance industry, because it's absolutely archaic. And there's very few companies that can offer digital end-to-end. And I suppose from our point of view, it's not an advice-based service. Okay. It's a very different service to what I do day to day in relation to my financial planning matters business, but it's something that people want in a particular transaction. So it's back to transaction versus advice. So that's why I don't feel financial planning will ever work in a banking environment. It's because it's very hard to give someone a journey of financial planning where you're adding value over 20, 30 years, because you're just a number on a spreadsheet, like 2 million customers of a big institution. Where if you go to someone like ourselves on the financial planning side, you're getting a bespoke advice based on your personal circumstances, because your circumstances, Ben, for example, will be very different to my circumstances, be very different to people that work with us. So they're different types of clients, but they're looking for different types of needs at different stages of their life.
Yeah, I think what you're saying about the digital end-to-end experience is just perfect. I think COVID was the perfect time where the technology just got to the right level. At the same time, everyone was forced to start to using Zoom, and it kind of broke the old system where you always had to go into the bank branch to sign it. Now everyone was much more happy talking to a broker over online, signing with DocuSign or other sort of forms online, and it seems to have really shifted the market. So now you can do, as you say, something like mortgage protection. It's not sexy, no offense, but it's something that you need to have done to buy the house, and that's the exciting part. It's getting the keys to your own front door. But look, it's something it's a legal requirement to have if you're getting a mortgage out, and you just want to get it done out the way. You've got a ton of other things to worry about, and this is something that you can just simply, with a few keystrokes, a few clicks on your website, you can get it done very quickly. And by cutting out all the people, the staff, the office locations, you can cut the costs and give them the best.
Yeah, the other reason, I suppose, why we've been slow to move in relation to other products is because I wanted to make sure that we had the digital journey and the user interface and the experience mastered, because this is something that you have to get. Okay, other financial products like income protection, illness cover, pensions, they're not mandatory. But if we can give people the experience that they get in their mortgage, because let's be honest, most people maximum will do 2-3 mortgages in their lifetime. So they remember you for making it as easy as possible, because we're trying to take away the stress at the stage of the mortgage journey when they want to just get it in and get done to the house. But essentially in the future is when we build out the proposition is that people will remember us for good experience, positive feedback, all that sort of stuff. So we can take that and build other journeys in relation to other products. So when they're at different stage of life, they can re-engage with us. So as you said, mortgage protection is not the most sexiest plan in the world, or insurance is not the most sexiest industry in the world. But essentially we serve a purpose for the client at a really important time in their life when they need supports. And when, as anyone who's listened to this podcast will know, that's come through Beat the Bank versus another provider, some people have applied 3 or 4 weeks before they come to us and saying, Jesus, I haven't got a reply yet. And we'll say, well, listen, we get your reply in a week. We'll get your reply in a day. Because we have access to underwriters, we've access to a business manager dedicated, we've access to all the lenders. If you don't get insured with the lender that we preferred provider we go with, we can go off to other chief medical officers. I've done it for people, and if they've ailments that they don't think they're maybe going to be covered for, we can step in early on in the stages and say, well, this is what we need to get you to the stage of you getting a mortgage protection plan. So it's back to your scenario there of going to the bank. That's fine. But we find a lot of people now, the mortgage age is sort of ticking up. People are getting mortgages later in life. If you're getting later in life, ailments happen. Obviously, you mightn't think it's an ailment or it's going to infect your plan, but it's really important for us to manage expectations. And the brand and the experience we build is getting people in early, educating them early, understanding what they're applying for, and then helping them along the journey to get them the peace of mind to know that mortgage protection is not going to be the blocker for them drawing down on a mortgage. Because unfortunately, the early stages of the site, we had people coming to us at the very, very end, like yourself. Unfortunately, they have ailments. A life insurance company is a risk manager at the end of the day, so they'll only take on certain levels of risk based on the information they're given. And unfortunately, not everyone gets cover. So if you don't get cover, it's really hard to draw down a mortgage. There is a situation where you can draw down a mortgage without having life cover if you're declined from a number of life companies and the bank are willing to accept that. But that's a very, very risky situation for yourself and your family to be in, having no cover available on a mortgage.
Okay, yeah. I wanted to focus on this topic a bit more because I see you advising people and commenting on this quite a lot. So often, as I did, you rush to get the mortgage protection at the last minute. And I was buying when I was 28, 29. It was fairly straightforward. We had no issues. We had a long life ahead of us. Hopefully, it was quite straightforward. But if people are rushing at the last minute and there's some technicalities or they have a pre-existing condition, they might run into problems and they might need some extra reports. What sort of issues do you find? What sort of pre-existing conditions do you find are a problem? And what do people need to do to sort of prove to the bank that they are, okay to be insured?
So we find a lot of people would, because people are more conscious of their health than maybe they were 20 years ago, is people go for tests, like whether it's through medicals, through work, or just random based on family history, right? So suppose things I would see on a daily basis coming in is things like diabetes. It's a huge amount of people have diabetes. A lot more now, They'll either have a combination of high blood pressure, high cholesterol. They might have family hereditary history in relation to cancer, heart attacks, or strokes before the age of 60, but whether it's a mum and dad, they mightn't feel that that's anything to do with them. But as an insurer, there is a strict, I suppose, criteria in relation to what they can accept and what they can't accept. So I suppose that is why early on I said to people is when you get your approval in principle, it's really important because like that's not going to really change. The amount you qualify for and the term you qualify gives you sort of the opportunity to go with a shopping on what properties you can sort of fit in based on how much savings you have. But essentially, if they apply early, there's things like we will need to get from people, which is what's called a PMA report from your doctor. So it's essentially a report that's sent out by the life company to qualify the information that you've given, to make sure the medication is right that you've said, and to make sure the dates around what you've given is secure. Because essentially, when you're applying for cover at the very start, it's like the claim stage, because they really literally look at the detail you sent in, and they look at where you're at in life or what happened when you passed away, and they make sure that they can pay out the claim. So it's really important to say is, and because a lot of people feedback again is, oh, well, Royal London are not as well known as other life companies in Ireland. Royal London pay out the most claims in relation to mortgage protection. They're the number one provider in Ireland for mortgage protection, and essentially they pay 99% of their claims in relation to mortgage protection. So whether underwriting can be a bit more stringent than maybe other companies, they can stand over the claims. So again, back to, I suppose, what the question you asked me is, getting in early and applying early will we can handhold people to say, this is what's required. This consultant report that you had from 3 years ago, you need to get that, because we can't chase up with the GPs. The GPs won't take any calls from us.
Sure.
We are an intermediary. So it's making sure that people understand that it's not like purchasing house insurance where you just put in the value, the rebuild costs, and you get the plan generated within 30 seconds. Yeah. There is an actual underwriting process. It can take time. We do say we can get cover through within a couple of hours. We can also get cover through in a couple of months. It all depends on the person's level of cover, their health history, their smoker status, and I suppose the term they're looking for the cover. So we will do our very, very best to help people through that process. But it can only be done if you apply early and get secured cover early. So you got the peace of mind to know that you can draw down the cover. So the illnesses is one. It's not to say, like, back to what I mentioned about diabetes and high blood pressure, cholesterol. They don't refuse people. Very few people get refused for that because there's different levels of it. There's type 1, there's type 2, there's high blood pressure, there can be high BMI. But essentially the outcome can be, there could be a postponement because you might have tests coming up. There could be a full decline because they feel they can't afford to take that risk on based on the information provided. There could be a loading on the plan. A loading essentially is that, listen, because you're on these certain tablets for that period of time, there's a 100% loading on the premium for normal rates or so standard
a higher
rates.
Rate, essentially.
A higher rate, but they're still going to cover you. You're still going to cover you. Yeah. Or there might be a situation where they might exclude you. So if you have a history or you've had say, for example, you had a valve fitted in relation to your heart, we'll exclude you for death in relation to heart attack. So people might say, well, then why would you take out the cover? Well, again, it's back to, if you don't take the coverage, you're not going to get the mortgage. But at the same point in time, it's making sure that they can stand over the claim. It's not personal because they have underwriters, reassurers behind them to say, can we take on this risk and can we stand over the claim? And I said, like, now, I mean, I'm talking about the 5% of applications that come in because most of them are straightforward. Yeah. But just as a lot of people will contact us asking us because maybe they've gone elsewhere, maybe they've got the answer they didn't want. And what I'm saying to you is, Ireland is a small pool. There's not that many insurers, so it's just making sure that you put the right information down, and also is that you follow through with the information they require because they're there to insure you. They're not there to not pay out claims. They're definitely not there to not insure you.
And is there any hope for anyone who's had serious illness, like say they're recovering from cancer or maybe they're in remission, Are they able to get cover? And is there anything around sort of COVID or long COVID that is causing people problem to get mortgage?
Yeah, I suppose at the start now, when we started the site in 2019, there was because COVID is very much unknown at that point in time, 2020, 21, is they're very reluctant to be able to, they might say it might be 3 months postponement or 6 months postponement since you had suffered COVID, because there were different symptoms and people had different reactions to it. Now, COVID is sort of
time if it was going to be benign, or if now almost 50% of the population have had it now, so it can't be a factor that excludes people from this anymore.
But essentially as well, there was different age categories it was higher risk for. Now, I'm not saying that COVID has disappeared, because it's not. But no. Essentially is they're not as strict in relation to, postponements in relation to COVID or long COVID, because we know it's kind of something we have to live with. And insurance companies know that, like, it's not going to impact a lot of people in ways, like in our sort of cohort between 30
mortgage buying
and 40.
Years, in their 30s and 40s, it's more likely to be a higher risk. And even there's a low risk, but a higher risk for 70-year-olds and 80-year-olds. Yeah.
Yes. So it's sort of dissipated in relation to, suppose, the amount of follow-ups and, queries in relation to when you got us, what were the symptoms. Now, there's one really important thing, is a lot of people who would apply early with us, is you're accepted for cover, is after 3 months, if you haven't drawn down on the cover, okay, they'll still stand over giving you cover, but you have to sign what's called a declaration of health. And what that essentially is making sure that nothing has changed in your health history since you applied to when you draw down the cover.
Sure.
Okay. So then when it goes over 12 months, is you have to reapply for cover because it's gone too long, and obviously you have to go back into the process. But just making sure you get accepted early, and then you can have a declaration of health signed and the plan documents issued. Now, once nothing has changed in your health in those 3 months or 4 month or 5 month period. But essentially it's the ailments are something that is part of life. We all live with them at different types of ailments at different stages of life. But there's absolutely no problem I suppose, and back to your question about cancer. Yes, cancer is obviously, listen, it's probably the highest claims they pay out for relation to illness cover. But once you've been sort of in remission for maybe 3 to 5 years, I would say to people, yes, it's absolutely apply for cover. I normally take people offline and say, maybe send me an email or send the chief medical officer for the life company an email, giving your background, the treatments you had, where you're at now, the medication you take, and how it's affecting your life now before you apply. Because I want to manage people's expectations, but at the same point in time is, I don't want you to apply and get declined, and then you feel that you've wasted your time. It's making sure that we try and manage the situation, because no two applications are ever the same, Ben.
It's good to hear, actually, that even though your system is digital and sort of somewhat automated, it's not a case of computer says no. If you tick the wrong box, I had something previously, it's a no. There is a process, a subjective process there that you can manage the situation. You can give extra information. You can go and plead your case essentially to the insurer, and they will give you something. That is encouraging.
Yeah, like I've had, there's 2 or 3 people probably listen to this who will know, because I've done it for them, is we have literally pushed back on underwriters and reassurers in relation to treated harshly in relation to loadings or being postponed or declined, and they've gone and got separate reports in independent reports, because like this means a lot to people. Like obviously if we're coming off renting to a mortgage, you're going to be saving on the money, and it's the biggest financial decision you'll ever make in your life. Yeah. So I understand that, because I'm in the industry 18 years. I've been through it myself 3 times and racially moved 3 times. So I do understand how important it is. It's not a computer that says, no, it can't be. Just because you move to digital doesn't mean you just forget about customer service. Like we have over 150 Trustpilot reviews. And the reason we have that is because I'm very passionate in giving people a good experience digitally, right? Which is what people want when they want. But if they need us to help them at some point in time, is to take it offline and follow up an email, or no problem making calls to people and sort of pointing in the right direction if they need it. But they're very few cases. But essentially, you can't just shut off the whole human interaction or customer service, because at the end of the day, we don't have a business if we don't have any customers. That's just a fact. So it's making sure, and we're not a big company, we haven't got budgets like the big life companies. So essentially is every person we help will tell somebody else because they've had a positive experience. That's really important to me. It's instilled in the team. It's every email needs through your, like an example would be, every email we get hundreds a day, has to be replied to within 24 hours. Because we have to be better than what other people are providing. The site is called that name for that particular reason. Because if we, at this point in time, it's not that hard. The
banks hate it, yeah,
it's not that hard for us to be in a more positive light than a bank, because they sort of shoot themselves in the foot in lots of different ways. But if we can help the consumer and the end user, and if I can help them, what's going to happen? They're going to come back to me and look for advice in other areas of their life, whether it's down the road, whether their kids need a mortgage, whether they're looking for advice in relation to educational funds, or if they're looking for advice in relation to old pensions or some circumstance change their life. They'll go, geez, those lads help me. I must ask them. That'll be the first port of call. So that's where we're at, is we're building a brand with a positive environment, with a positive team behind me, that we can essentially give them what they want, when they want, and then they can re-engage at some point in time in the future.
Yeah, it's great to see a company being built up from the ground up, essentially. And as you mentioned, your Trustpilot reviews are glowing. And the people, we see on Instagram, people like Kieran at Crazy House Prices that used you and recommends you highly. A lot of people are giving really positive responses. So if anyone's out there and they're getting to that stage in the sale agreed, or even before that, let's get them in early, as you say. And instead of hearing what their bank has to say on the mortgage protection, life insurance, what should they do? They come to beatthebank.ie, and then what's the process, and what do they need paperwork-wise to apply with you?
So essentially, I'd say for someone who doesn't have any ailments, sale agreed is probably a good time to get in, because you're as I said to you already, 8 to 12 weeks is probably the drawdown time at this point in time in where we are. It can be quicker, but that's probably a good time frame. If you have any ailments, you get into the approval in principle stage, because that's not going to change the amount you qualify for the term. But essentially, it's what you do. You come onto the site, beatthebank.ie, you put in the amount of cover you need, your age, the term you need it for, whether you're a smoker or non-smoker. We have built an engine in the background that looks at all the life companies in Ireland. So from your Irish Lives to your Zurichs to your Avivas to New Ireland to Royal London. And what it does is it takes all them and it discounts it. So we take a large chunk of commission sacrifice on the plan. And the reason we can do that, as I said to you, is back to, we don't have tens of people in a call center environment having to take calls. Okay. So what happens then is you get the premium. The premium will be guaranteed to be the cheapest in Ireland. Okay. And again, cheapest, I would say to you, people say cheapest isn't always best. But what we're doing here is we're giving you a better product than what you would get if you went to a large institution like the pillar banks in Ireland, because they're, as you know, they're tied to one insurer. So when you go to New Ireland with Bank of Ireland, or you go to AIB that goes with Irish Life, they're tied to one insurer. We're discounting the whole market, okay? Now people will say, well, we don't like that model in the industry because, listen, you're it's called aggregator model, like the moneysupermarket.com. We're giving somebody an experience that's far slicker. So once they're happy with the quote, they can either email the quote themselves and say, we're actually not in the process of buying yet. We don't have our AIP yet. You email it to you. The brochure's there, the term is there, everything's there. The quote is valid up until your next date of birth, or 30 days, depending on which comes first, okay? Or if they say, actually, we're ready to go, we've done our research, you click apply now, it brings you straight to the application process. You fill in your application, which can take maximum saying 4 or 5 minutes, depending on, again, back to ailments or no ailments. But I said 95% of people, it's straight through. And essentially what happens is then it goes straight into the underwriter, and it's in the queue to be seen by an underwriter within 24 hours. So we have turnaround times and SLA or service level agreements with our providers to make sure the person stacks up with our sort of values, which is getting back to people in a timely fashion. So then people will either get, next steps will be some people get emails within 3 hours. You're accepted. Some people get emails saying you're accepted in 24 hours. Some people say, well, we need the following details, like maybe, for example, asthma. Do you use an inhaler, or how long have you had it? Simple things just to be clarified by the underwriter that doesn't have to go to a doctor or their previous doctor or the current doctor. So once that's there, the decision is made, and all that happens then is they give us a start date and we get the plan documents and our email directly to you. So one question people always ask me is, well, hold on, I haven't got a house yet. I don't know where I'm going to buy. What address to put on? I said, put the address on of your parents maybe, or put the address of maybe your where you're renting, but the documents get emailed to you. So because, again, back to the environment of, you have to print the documents, bring them physically to the bank. The deed of assignment had to be signed by the solicitor, had to be brought then to your provider. Now it's digital. So it's a digital certificate. You get sent, cover, called a policy schedule, the amount of cover you get, the term you get it for, and you send it to your lender and it's accepted.
Fantastic. Great. Yeah, it does seem like it's taking the hassle away of something that shouldn't be delaying people at this stage in their buying process when they've got a lot of other things going on and they can get the best rates as well. So that's fantastic. Well, so everyone, Niall, can find you, beatthebank.ie. You're also great on social media as well. Your Instagram is the same, beatthebank.ie, and you do a lot of really good posts there. And where can anyone else find you?
So I started Financial Planning Matters, which is our core business, which would be, we deal a lot of tech companies, professionally self-employed, young professionals and their families. So we build financial plans for people. So
great.
FEMS.ie would be the main core business where I'm in the day. I'm very, very fortunate to have a good team, both camps. So I suppose Beat the Bank is something I would do in relation to, if there's any queries come up in relation to medicals, stuff like that, I definitely get involved. But the day-to-day job for me would be building financial plans for people, adding value at different stages of life. I have a background in 18 years in the industry. I have a master's. I'm what's called certified financial planner. So I suppose I'm giving people different experiences based on different stages of life. But predominantly FPMS.ie is where I'm at.
So if anyone needs more mortgage protection, they can come to you there as well for more sort of wholesale, larger financial advice and guidance.
Yeah, I'd also say on beatthebank.ie, we're launching income protection because for me, it's probably the most important financial product you'll ever take out because it protects your income between now and retirement. So we're building and testing at the moment. That will be live in probably the next month. And obviously, if you're taking out a mortgage, it's really important. But obviously, the income drives the repayments of the mortgage.
Yes.
Some people haven't worked if they're fortunate enough to work for a big tech company, but Ireland is built on SMEs and sole traders. So it's really important that they understand that while they're in that buying cycle of a house and a mortgage protection, they understand that that's probably the most important financial product that you'd ever buy in your life. And you get tax relief on it. The government give you 20% or 40% back.
Right.
So that's the next stage.
If you lose your job, or is that for serious illness?
So that's out if you're ever out of work due to injury, illness, or accident. So it doesn't have a list of illnesses. It actually covers a vast array of them, and you can claim as many times you want between now and retirement. But we would see people being out of work for longer and not passing away because people live much longer now, but get diagnosed as illnesses younger.
Yes. Okay. Interesting. We're looking forward to seeing that, and you're going to have a whole suite of products there with Beat the Bank in the next few years. So I'm very excited about that. Well, Niall, thanks for coming on today. It's been great, and I think it's been really useful for my audience.
No, thanks for having me on, Ben. Really appreciate it.
Welcome back to our final features. We're going to be covering In, Out and Away, where we look at an area where you can buy a house in Ireland, within the city, on the outskirts of the city, and away out in the countryside. So far, we've done Dublin, we've done Galway, we've done Cork. I thought we'd go for another fine historic city that we haven't really covered yet. And this week, we're going to Limerick. Limerick is a great town. There is a lot of great old Victorian and Georgian property stock in there. There's also a lot of dereliction as well. Unfortunately, it's one of those cities that needs a huge improvement, but could be an incredible town. But there are some great bargains to be had if you're working in the area or commuting from there. Limerick could be a great town to buy a house affordably, and you may get more value for money than elsewhere in the country. So for this week's In, Out and Away, we've set a price range of under 300,000 euros, basically from 250 to 300,000 euros. Let's see what we can buy. For our In this week, I've picked out this 44 St. Joseph Street. It's on the market for 250,000. It's a 3-bed, 1-bath, extended to just over 100 square meters. The red brick mid-terrace, lovely red door, very striking. Going inside, it's in okay condition. I could move in now. It looks like it's probably been a rental or hasn't been updated for many years. But it's only a small house. You could quickly update this with a little bit of spare money after you've bought it. This could be a fantastic family home, small 3-bed. But if you wanted to be in the heart of Limerick city centre, you couldn't get much better than this. You're only about 1 street away from the People's Park, the main station, and the main hospital there as well, and very close to the River Shannon. This could be a brilliant family home for living in the city centre. The main downside is it only has a very tiny courtyard garden, and the parking is on street outside. But these are the things that many learn to live with living in the big city. Now for our Out this week, this looks like a property that would normally be in our Away section. It's an old kind of farmhouse with a historic barn next to it. It's actually only just on the outskirts of the city, within the ring road, this side of the Clonmachan roundabout, and it's very close to the river, as the name would imply. This is Shannon View. It's on the market for €290,000. The main house is a 3-bed. It's got 2 large rooms downstairs and 3 beds upstairs and 2 baths. And then there is a separate barn with a huge ground floor and then a vast open plan, rafted beams, open space. This could be a fabulous unit. You could turn it into workspace. You could make it part of a living space for the house. You could even use it as a yoga studio or something like that. Huge ideas with this house. Only for €290,000. This is an incredible buy. The main house is 100 square meters, but then the barn is probably the same again. All in all, it's on 0.6 of an acre. What a contrast this is with our inn property. Similar amount of house, but a huge amount more outside space, and that barn which you could do something with, all just on the outside of the city. Finally, for our away, I really had to push out a lot further outside of Limerick to find something interesting here. I've come about 45 minutes to the north. This is Clondorney in Tulla, in County Clare, just over the border there. It is a detached 4-bed, 3-bath house. It's 165 square meters and it's C2 rated. Built in 2006, this is a beautiful, modern-looking farmhouse with whitewashed outside walls and 3 beautiful peaked roofs. Inside, there is a stunning hall of marble on the floor, open-plan staircase, and there's some beautiful living spaces on the ground floor here. 2 cozy living rooms, and then a large kitchen with a big island unit and a separate dining room to the side, opening out onto the garden. Upstairs is 4 bedrooms, 1 master ensuite, and then a family bathroom as well. Overall, it's situated on half an acre. This is a beautiful, beautiful house on the market for €300,000. That's fantastic value for money if you're happy to either work from home or a 45-minute commute into Limerick wouldn't bother you. So which would you choose? In property, Joseph Street, over 3-bed red brick terrace in the heart of Limerick City. A Shannon View on the outskirts on the ring road there, the attached house with the barn. Or would you go for the beautiful, modern, 165 square meter detached house out in the Clare countryside, about a 45-minute commute from the city centre, all under €300,000? Tell us which one you would choose on our social media. Now, for new home versus old home, we're sticking with Limerick, and we have found this beautiful scheme of new builds in a little town on the west side of Limerick, just outside the city centre, called Mungret. It's a Kosh Temple, the new build scheme being sold by O'Connor Murphy estate agents. There's a range of 2, 3 and 4 beds, starting with 2 beds for €290,000, moving up to 3 beds of a terrace of €365,000, a 3-bed semi-detached is €390,000, and the 4 beds are €450 to €500. This is an attractive looking scheme of modern houses and nice landscaping. You're close to the Limerick University Hospital there. There's a new Educate Together around the corner. This will be a fine location if you wanted a brand new build just on the outskirts of the city. These homes are built to a brilliant A2 standard with air-to-water heat pumps, underfloor heating on the ground floor, and finished to the front with nice Kilkenny limestone. So if here you can get a 3-bed terrace for €365,000, that's about 110 square meters. Or let's look at our old home. And you know I like a contrast, so I picked something as old as I could find. This is the Coach House, built in the 1860s, as the name implies, as a coach house for one of the neighbouring larger estates. It has been recently and modernly converted in 2003 to a nice 3-bed family home. It's 107 square meters, so it's actually the same size as the new build 3-bed terrace in Kosh Temple, but it is quirky in design. The interiors probably need an update, but it has some fine features such as exposed walls on the inside. Upstairs is 3 good-sized bedrooms and a bathroom. It's a D2 rated house, so some work to be done there. But look, it gives you a bit of history, and how do you think this compares to the new? It's a fine, interesting period house that has been cleverly modernized. Needs a bit more work to be done again, but compare that to the brand new build A2 rated for a similar price, similar size. This is probably the easiest one I've had so far. I think I'd probably go with the new build, even though I like the older houses. They do look pretty good. But you tell me what you think. Go to our social media at Irish Home Magazine and vote for which one you would choose. Now, this week for our news, I am going to be covering a survey that was carried out by switcher.ie, your go-to place for online comparison of broadband, energy, mortgages and insurance. They have just released results of a study about the best places to work from home in Ireland. They mainly looked at access to broadband and 5G mobile, but also things like access to green spaces, the outdoors, the coast, number of gyms and leisure centres in the area, number of cafes and coffee shops and food delivery services, and proximity to health services and surgeries, GPs and schools. They released the top 10 list of the best places to work. Some of the top 10 include Longford, Gorey, Clonmel, Mallow and Portmarnock. The final top 3 were number 3, Navan, popular commuter town, but also in its own right has a really vibrant high street with shops and boutiques and restaurants and takeaways, as well as very high broadband and 5G levels. Number 2 was Leixlip, a brilliant town on the outskirts of Dublin, but also a great little centre in its own right. Loads of sporting facilities and outdoors around you there. And finally, the number 1 was Castlebar. They call it a vibrant market town with a winning mixture of leisure amenities, speedy broadband and 5G, and plenty of green space. Other highlights include the best towns to keep fit and healthy. They were number 1, Gorey, 2, Malahide, and 3, Castlebar. These are areas with lots of parks and a high number of gyms per 1,000 people. The best place to work from home with a family, number 1 again, Castlebar, but number 2, Arklow. I'm very pleased to see that in my hometown here. And then Middleton, and then Cove, and then Enniscorthy in the top 5. These are towns where house prices are reasonable, crime rate is low, good number of GPs, and some very high-ranking schools. Now, the best small towns to eat at home or on the go, they came in as number 1, Navan, number 2, Galway, of course, but then 3 was Naas, and 4, Bray, and 5, Carlow, all towns with a good social scene and a lot of food and restaurants and takeaways. Finally, they did release the bad list, the 5 worst towns to be in for broadband and 5G specifically. And they were number 5, Tullamore, number 4, Skerries, number 3, Selbridge, surprising, number 2, Cove, unfortunately, and number 1, Shannon. If you want to see more about the report, it's very interesting. There's more detail there. Go to switcher.ie, and it's a great place to go to do some comparisons on your mortgage and your insurance and your broadband and energy bills. That's us for this week. Thanks very much for tuning in. We've covered most of Sale Agreed now. If you are thinking about mortgage protection, get in there early. Go to beatthebank.ie and talk to my friend Niall there and get your mortgage protection sorted sooner rather than later. In the next couple of weeks, we're going to be tailing off with a couple of the last bits and pieces before you finally move house and start thinking about what you're going to do to your new house when you get into it. So stay tuned. Subscribe to Irish Home Magazine, because even after we finish this season of buying your first home, we're going to have more seasons about more interesting topics around the house and home in Ireland. And we have loads of stuff over on our social media as well. Go find us at Irish Home Magazine on Instagram and TikTok and Facebook. All the best. Thanks for tuning in, and I'll talk to you next week.